Give
So
us
it's
more
97.
details.
The Smart Start's 97% first, up to 766, with a 2% second.
What is 766? 766.
It's conforming loan limit.
We have different conforming limit here. We have 1,149,000. What's
Yeah,
wrong with that?
super
It's
conforming.
conforming, not high balance.
Gee, you see, you're cheating me. You're giving me something which, okay, doesn't matter.
That's
I'm
why I
just
said, it's probably something, if you guys get something in that realm, let me know. There's no MI, and there's a free second, 2% second, that's zero interest, zero payment, and forgiven over 3 years. But they're looking for properties in low to moderate census tracts, and there are income limits. So I encourage you, just if you get anything in that range, give me a call or shoot me an email.
okay. Condominiums.
Investment properties.
No, hold on one second, Brad. Condominiums. Can you do condominiums in this program?
Yes, as long as they're warrantable.
Well, yes, it's warrantable. Okay.
Investment properties have changed. The loan amounts aren't as high as they were at WaFd Bank, and there are, it's not unlimited properties. They're limited to 30 properties owned, but we did pick up reverse 1031 exchanges. So that's nice.
Hold on, Brad, you're ahead of me, because I want to go back to this this 1% down. Okay.
Yeah.
So how do you, because this price range, there is a number of projects in San Francisco which condominiums are in this price range.
Mm-hmm.
Okay. So this is the only thing I know, because here in our area, homes, well, maybe they are, but I have no idea. So if, let's say, I have a condominium, warrantable condominium, and what would be the difference between FHH Calhafa and this program? Because Calhafa, we can do zero down payment.
Yeah, I mean, the difference is there's no MIP or MI.
There is no MI on Calhafa either, right?
And you get the free percent. You get the free second too.
Okay, so this is a benefit. So if person is buying today for 760,000 and or 676,767, because you have 1% down, right? And
Right.
loan amount 760,000, they can get a free second.
A 2% second, that's free money. Yeah, it's forgiven over 3 years.
2% of the loan amount. So it's now, in this case, about 15,000.
15,000 is the max. Yes.
Yeah,
But
exactly.
how long a person needs to keep this property to get this second forgivable? Is it some specific requirements?
Yes, 3 years.
3 years. It's forgiven 25% the first year, 25% the second year, and 50% the third year.
Okay, so perfect. In other words, the person needs to have, in this case, 7,600, or let's call it $8,000. Okay, person needs to have $8,000, and they can get 15,000 second, which will after 3 years is gone, and the balance of whatever. Let's say we're talking about 660 minus 24, so we're talking about 750. Let's call it 740, 730. Let's round it up. Okay, let's say we have a loan amount of 734,000. Okay, now how do we price it? Is it FHA loan or is a Fannie Freddie loan?
It's our own product.
It's your own product. Okay, perfect.
And I've been arguing about the pricing, because the best price you can get is 7 3/8 at an eighth cost. And I've let them know that, on these products, the borrowers need to probably do lender paid, because they're already
Lenders paid because
Yeah.
it's difficult to qualify.
Well, it is, there are income limits, but also, if somebody's putting 1% down and then they have to, do borrower paid and pay, a couple of points, it's probably defeats the purpose a little bit.
So hold on. So you're telling me this is a borrower's paid?
Yeah, right now the pricing on the Smart Start is borrower paid only.
I see. Okay, so hold on. Let's just it's just numbers. Okay, so let's say it's we're talking about 1.5 point. We will collect 1.5%. Okay.
Yep.
Let's call this for simplicity 11,000. Okay. So we have 11,000 plus 8,000 from the down payment plus closing costs. Right? Let me repeat it again. So basically, what we have three numbers for calculations. We have 1% down payment. We have 1.5% of our fee, and we have closing costs about, let's say, 7,000. Correct?
Mm-hmm.
So we're talking about that 7,000. So we're talking about 26,000 total. How much person needs to have to enable them to buy this property for 765,000.
Right.
768. Okay. Now we establish this. Now you're telling us about income limits. Because now they sold the property yesterday and now they're buying, they don't own it. It's not first time home buyer. First time home buyers limited to owning property within 3 years. Here there's no, they don't say it.
Right.
Okay. Now my next question, I'll have to calculate it. So if I have loan amount at 730 something, and at 738, I have to be sure that person is going to be qualified.
Right.
So what's the limited income?
It is if it's a low to moderate census tract, it's 120% of AMI, and if it's not, it's 80. You have to look it up on the ffiec.gov website.
Okay, so it's like census tract before, all right. So now what from our point of view, from marketing point of view, we have to first identify if property is located in a census tract. It's number one. And then if it does, we have to see for listings in that area. And then we reach out and the price range up to 768. And then again, we can reach out to the listing agents and inform them we might be able to finance this property with somebody who has just 26,000 for down payment. Can the down payment be a gift?
There is gift allowed on down payment and closing costs. 1% reserves.
You need 1% reserves, so we need more.
Yep.
So you need 1% reserves from what amount? From PITI?
Right.
Okay. So let's say PITI in this case is going to be, let's round it up, $5,000, $6,000. So we just need another 6,000. So we are talking about 32,000 of the gift. So let's say if parent wants to help the child to buy their first condominium in San Francisco with a price of 768 approximately, it's possible. You see, in other words, we need to analyze it not just on the surface of just what it is. We have to analyze it from point of view how this can be utilized. So my task is now to identify the area, to check if it's what will be the maximum loan amount, and calculate based on that income, calculate based on this what can be done, and then go out to the marketplace and give them opportunity to benefit from this wonderful thing. Okay?
Right.